Hello, everyone. Today on the final bar, we'll talk about a market that rotated from strength to weakness, from accumulation phase to distribution phase, just within the microcosm of today. Quite the distribution going into the close, making a lot of charts that had been in pretty decent uptrend started to rotate and show some signs of short-term weakness. What does it mean relative to the short-term configuration, and how does that tie into the longer-term trends? We'll look at all of that and more, ladies and gentlemen. This is the final bar. Hello, everyone. Welcome back to the final bar. This is Dave Keller here at StockCharts.com in a rainy Redmond, Washington. Just back today after a long weekend, a 4-day weekend down in the Mount Hood area of Oregon. We had a lot of fun with the family, sort of unplugging, getting away. And I'll tell you, if you've not taken a couple days away from the markets in a while, I highly recommend it, even during periods of dislocation, because it certainly helps to give you a perspective on things. I know looking at the charts first thing this morning after getting back last night was really interesting. It was great to get a fresh take on what's happening, and it's so easy to get caught up into the flickering ticks of the short-term movements. As I was reviewing the charts and then watched today happen, the morning as I was going through a lot of the charts and how they'd evolved through the end of last week, showed some signs of renewed strength, particularly in places like energy, financials, other areas where you've seen some bouncing higher. In the afternoon, though, you saw things started to rotate lower. And as we're preparing for the show today, you could certainly feel this distribution. If you start the clock at lunchtime Eastern and go to where we're at the end of the trading day here, it's certainly hard to see that as anything but distributed, particularly in the last hour where you saw a lot of selling pressure to the downside. We're going to get to all of those charts and more. Monday's a lot of fun because we get to hit the market from three different directions. We'll get to that in a minute, but I did want to highlight some of the guests we have coming up on the show. First off, definitely wanted to thank Julius DeKempener and Tom Bowley for hosting the show last Thursday and Friday. They did a fantastic job breaking down the market activity, applying their own spin to things. This week on Tuesday the 12th, we have Ari Wald from Oppenheimer. On Wednesday the 13th, Clint Cowles from TD Ameritrade. On Thursday the 14th, Jeff Hughes from JWH Investments in Minneapolis. And then coming up next week on the 19th, we have Katie Stockton from Fairlead Strategies in Connecticut. Let's continue on with today's market recap. So on Monday, we hit the market from three directions. We start with top-down macro, big picture. What are the overall chart configurations? What are we seeing big picture? Then we'll talk about sectors. We'll talk about some of the rotation. We use RRG visualization to show the 11 S&P sectors. And then we'll come back from the break and talk about shifting stocks. We'll focus on the names that are on the move, some of the key charts I think you should be aware of. I think today really represented the overall market conditions we're in. There's this bounce right out of the open. If you look at the short term, the 2-day chart of the S&P, there's this bounce out of the open showing you some buying power, right? Some initial interest on the demand side outweighing supply. Prices bounce higher a little bit. This is when we start to think about the S&P, pushing higher. What does it mean if we break out of this little range? By the close, though, it's more distribution, right? It's more, pressure on the downside. Some of the sectors that had been doing just fine earlier in the day really pushing down to the lower end. And it's really the defensive stuff primarily that ended up on the top. Things like real estate, consumer staples. Though you have materials, things like FCX that had just a pretty decent day up at the top as well. So overall today, the S&P 500 down 0.7%, closing just above 4360. That's down from Friday. We were at 4390. The Nasdaq and the Nasdaq 100 both down about the same as the S&P. No real difference there. And the same thing when you look at mid caps and small caps. There have been days when there's a huge differentiation or huge dispersion between those different indexes. Today, not much. Everything was sort of down about the same amount. So I would say no real necessary themes there. The VIX higher and back right at 20 at the close today. Bond markets were closed today. So for the Indigenous Peoples Day holiday. And so there's no movement today. You will see obviously things come back, and the bond ETFs trade a bit really pretty quiet day overall. And in general, a day like today, which is kind of like a partial holiday, equities were open, bonds are closed. It's sort of like a half day when you think about the overall movements all around. But interest rates, I think the story has certainly been rates going higher, 10-year yield getting above 160. Commodities overall mixed with gold and silver down, but the other side of commodities, energy up just fine. Energy was one of the better sectors in the S&P, although still down, and the USO was actually up. So kind of a choppy day, but gold prices really moving downwards through the course of the day. Where you are seeing plenty of strength is with Bitcoin. You have Bitcoin getting back near the 60,000 level. We've not touched it yet so far this year, but certainly accelerating back into that range. Currently just above 50,000. This is up from around 54,000, 54.5 at the end of the day yesterday, and over the weekend really accelerating and continuing that push higher. Let's look at some of the individual charts and see what sort of themes we can tease out. So, I mentioned to my own subscribers earlier today through market misbehavior, what the overall take is on the S&P 500, and I would tell you this. I think when my medium term model turns negative, which it did in May, when my short term model turns negative, which it did, I think about 4 or 5 weeks ago, 6 weeks ago, maybe, tells you overall that there's in a position of weakness, right? That the markets are overall in pullback mode. And I think pullback mode is defined by the short-term pattern of lower lows and lower highs. And I think in mid-September, when we undercut the August low, that was notable. Early October, when we once again undercut that next low, that's what tells you that the trend overall is down, especially the tactical trend, right? The short-term trend. You have the high, the new all-time high around 45.50 in early September. We've now made a lower high in late September. We've now arguably made a low high here in early October. So the market is still in downtrend mode, particularly in the short term, as long as we continue to make lower lows and make lower highs. For the last week, I think we've seen that pattern perpetuated. So while the bounce Thursday, Friday, I think on the surface feels like, all right, could that be the beginning of something, bigger and more exciting? I don't think so. And I think until you change that pattern, you have to make a higher low, which would mean we need to close, this, if we do pull back or continue to sell off through the course of this week, we'd have to set a low above 4,300 or so, which is above that October low. And then we'd have to make a new swing high, which means there's a lot of work that the market needs to be done, needs to do before you could signal sort of short-term all clear. I still see things as heavier rather than lighter. I think days like today confirm that distributive tendency, the fact that the RSI is remaining below 50, everything is still indicating further downside before further upside. I think some of the places where we might look for a change there are things like financials and energy. We'll get to that here in a little bit when we talk about sector rotation. It's funny, the bond markets are closed, but I think when you think about the story, I think the interest rate story is certainly a big part of what you need to think about. We'll talk about the shape of the yield curve a little bit, but overall, just looking at the 10-year yields, this is round trip now from 175 down to 112, 113, and now up above 160, and we're back in that range that we were in March through June. If you remember, this is when we talked about not confusing the top of the page with resistance. This is when we talked about the sell-off in bonds and the question, how high can rates go? The answer is a lot higher than you might think. It seems reasonable back here where we're in a 0.5% yield on the 10-year that we could get up to 175, but we did it about 8 months later. And so when we came back down and now are rotating back higher, there's no reason why we can't get to 175 again. There's also no reason why we couldn't get to 2% plus on the 10-year yield. I would forget about what should happen, what could happen, and focus on what actually is happening. The charts are telling you that bonds are in a downtrend, and that rates are certainly going higher until proven otherwise. Continuing the macro, a couple quick charts before we get to our sector rotation look. I think the chart of cryptocurrencies overall very constructive, and particularly in Bitcoin. You had some headlines over the last couple of days that have continued this upward push with Bitcoin. I think I will never say a chart is easy, but often you'll hear me say something like that because sometimes I think the charts just give you a very clear signal, right? Bitcoin hit 50,000, and that is not surprising because 40,000, 50,000, 30,000, 60,000, those big round numbers have been very meaningful for Bitcoin in particular. So getting above 50,000 was important, remaining above there, and that serving as a new support level, I think, is vital. We're remaining above there and continue to push higher. I think we retest those previous highs, 60 to 64,000. That's where I'd be looking for additional resistance. But overall, again, the path of least resistance on Bitcoin appears higher, just like the path of least resistance on stocks and on bonds together overall remains negative based on the charts that we're looking at. Let's continue on. Go to the second piece of our Monday show, which is looking at sector rotation. Let's talk about the big picture. Talk about stocks overall still being fairly distributed. We'll touch on the breadth here in a little bit if we have time for it. But I did want to talk a little bit next about sector rotation and think about how these 11 S&P sectors are rotating around the benchmark in the middle. We'll do a couple looks to try to make sense of this. We start with the RRG, and again, if you missed Julius DeKempener's show on Thursday, he hosted the final bar, did a really good job, but focus a little bit on some of these rotational themes that we're going to touch on here today. And overall, it's been a story of rotation, particularly in the last 6 weeks or so, away from the growthy stuff. So on the weekly RRG, you can see technology rotating down, heading southwest, which is sort of the direction of deterioration. Healthcare as well, rotating down. I think some of the charts that have had the clearest rotation from accumulation phase to distribution phase, arguably in those growthy sectors, and particularly in healthcare, right? If you look at some of those groups like medical equipment, medical supplies, even some pharmaceutical names, you had some really strong uptrends that all are now rotating lower. And if you're wondering when is this pullback done, those are some of the individual names I might be looking at, particularly in healthcare. See if they find support, see if those pullbacks resolve, and if you start to see renewed strength. There's only one of the 11 S&P sectors that is now in the leading quadrant using the weekly RRG, and that is the financial sector. The most strongly improving sector is certainly the energy sector. On the daily RRG, you can see how strong that is relative to some of the others in terms of its movement. But overall, you're seeing some improvement in two particular areas, financials and energy. And again, while further to the right, it's been a stronger outperformer. And so technology is still telling you it has been the strongest in the weeks leading up to today. In terms of the most improving, the sector that is showing the characteristics of outperformance going forward, it's really the financial sector that is the outlier relative to the others, which many of them are actually struggling quite a deal. On this chart on the RRG, what I would be looking for are two things: the XLY, the XLP, those consumer sectors, which are actually the others that are heading in the direction of improvement, heading northeast. In general, things northeast, especially in the improving quadrant, are the opportunities. That's where things are really starting to improve on a relative basis. That's where you're seeing emerging strength. That's where stocks are starting to break out. And you can see how financials did that in the lagging quadrant, heading now in the direction of improvement, getting into the improving quadrant over the last couple of weeks, and now emerging into the leading quadrant. So out of the 11, financials certainly the most constructive out of the 11 sectors there. When you look at the candle glance page, and again, the way I tend to think of this is taking a bunch of charts, printing them out, spreading them out on your table, and starting to sort them. What charts start to look good? Which charts start to look not so good? And if you don't have a printer with endless amounts of paper and a bunch of charts to print out, you can use the candle glance function. Use a piece of paper, which is what I do all the time. I have a notebook next to my keyboard at all times, and I'm always jotting tickers down, sketching out some of the patterns that I'm seeing, and it's a way that I track movements, particularly on groups and individual stock themes. And when I'm looking at the 11 S&P sectors this morning and sort of taking a fresh look at things, two sectors stand out as much more improved charts and much more constructive setups than the rest. And it's the two that we just mentioned on the RRG, financials and energy, right? If we start with financials, which is in the top line, fourth from the upper left, you can see that this is one of the few sectors that is actually making new highs in the last week. All the growthy stuff, things like communication services, things like technology, even things like utilities and real estate, are really more defensive. These are all rotating well off of their previous highs. They all made all-time highs in early September and now rolling over and testing new swing lows. Same even with staples and consumer discretionary. When you look at financials and you look at energy, you can see how these are really the outliers to the upside, right? Sort of the positive outliers. With financials, you can see that this is a sector that's been pushing to new all-time highs consistently. A lot of the other sectors, particularly September into October, are rotating lower and testing moving average support. This is actually a sector that's testing new swing highs. It's actually made a new all-time high today, intraday. Now closed at the lows of the day, which is not short-term encouraging, but overall in terms of the structural setup, the trends overall are holding up very well. It's making higher highs and higher lows, and the relative strength is improving. We can look at the energy sector, and you can see sort of a similar setup to that. You can see the XLE making new swing highs, getting above the June high over the last week, and again making a new intraday all-time high today, but pulling back and selling off and closing at the lows. So I think as you're thinking of the markets between now and year end, and thinking of where the opportunities might be, I would not be surprised. I would actually be surprised if S&P did not finish higher than where it is today. I think overall, you most likely see some improvement after enough of a pullback. You'll see demand coming in October, especially late October through November, December tends to be seasonally pretty strong for stocks. So I think that's a pretty safe playbook to have in mind. But the question is what actually leads the way there? And when I'm looking at the setups in energy and financials, I'm seeing strength. When I'm looking at setups in some of the growth areas like technology and consumer and communication services, I'm seeing weakness. And until that picture changes, I'm much more inclined to follow areas of strength than areas of weakness. I'm particularly looking at financials. Are they able to hold some of those highs? When we come back from the break, we'll look at one of the regional banks that I think might be an interesting one to watch. And then also in energy, you see a sector here making new highs while most sectors are not. You see improving relative strength when a lot of the sectors are actually showing deteriorating relative strength. In general, at all times, I would be leaning into what's working, leaning away from what's not working. Energy is one of those that certainly appears to be working. We need to take a quick commercial break. We'll be back with my next segment, Shifting Stocks. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thanks so much for joining us every weekday after the close as we focus on the message of the markets, focus on the charts themselves and what they can tell us about evolving financial conditions. A couple quick comments before we get to my next segment, Shifting Stocks. First off, we love to hear from you. Feedback on our show, on our posts, on the channel in general, the topics that we're covering. We love to hear all of that, but we especially love to hear your questions. We are here to help point you in the right directions, better anticipate or identify opportunities, and manage risk using technical analysis. You can get questions to us a couple different ways. Via email, thefinalbar@stockcharts.com, via Twitter @finalbarsctv, via YouTube, put a comment on our YouTube channel. We'll gather all those and hope to answer one of your questions on our next mailbag segment, which will be on Tuesday's show of this week. Also, go to stockchartstv.com. That is our on-demand platform. We have so much great content coming out, new content every weekday to help you make sense of the market environment. You can go to stockchartstv.com, use your email address to set up a free account, or just look on any of the app stores on your mobile devices. Search for StockCharts TV on demand. Our next segment is called Shifting Stocks. This completes our three-pronged approach to market analysis every Monday. We started with the big picture, talked about the S&P, and again, today as a microcosm, as an example of what I think the overall conditions are. There's enough upside to draw people in. There's enough distributive pressure, enough selling pressure to remind us that I would argue this is still very much a market in distribution mode and proven otherwise. We're still showing internal weakness and distributive patterns on individual names and on the broader indexes as well. We talked about setups, the strength that we're seeing in financials and energy versus the deterioration on a relative basis in some of the growthy sectors. I would imagine that those are themes that could certainly continue on through year end. I would be looking at the charts to see where the relative strength emerged. But at this point, it's certainly in financials and energy over the other sectors. Now let's look at some of the individual stocks that I think are important to watch. And again, these are just charts that have come out of my own work in the last day as I've been plugging into the markets. And again, I'd remind you, if you've not taken a break in a while, unplug for a couple of days and look at charts with fresh eyes. You'll find a lot of things just seem very, very clear all of a sudden because you've gotten away from what we call the flickering index, the short-termism of following the markets day to day and minute to minute. The chart of Home Depot is actually a really interesting place to start. When I think about the markets overall in distribution mode, which I argue they are, it's worth noting that there are plenty of stocks that are still holding up just fine, right? If you look at the chart of Home Depot, this is a chart that's in a basing pattern. And a basing pattern is a general way of describing a stock that has hit a resistance level and now it's stabilized, right? There's a period of equilibrium. So you have a rally period on the chart, March and April, going into a new high in May. This is Home Depot getting above 300, and really showing signs of strength. You've then arguably had a 5 or 6 month period where the markets, where the stock is in consolidation mode, right? The market can go three ways: up, down, or sideways. This is a stock in sideways mode, and it's really hit an equilibrium. Over the last 6 months, the market has told you that Home Depot is worth between around $320, $340 a share, and that's about the right amount where Home Depot should be. At some point, when a stock is in a basing pattern, one of two things tends to happen. Again, either you break to new highs, which indicates that something's different. We are no longer in an equilibrium around that particular price point. Buyers are taking control. Bullishness is outweighing bearishness. Demand is outweighing supply. Whatever the way that you would think of it, the market is telling you that higher prices are justified. And I think in general, the essence of momentum investing that we're talking about here is the fact that you should follow those trends, follow that momentum breakout to the upside. The other thing that can happen is a base does not break out. You have a failed breakout where it attempts to get higher, but buyers are not actually pushing the price higher, and the price starts to deteriorate. That's where you need to start to look at a chart of Home Depot and see if it undercuts some of the previous swing lows. What we've seen in the last couple months is a pattern of high highs and higher lows in the short term, and now we're nearing that long-term high around 340. My question this week for Home Depot and other charts like that: can we propel above those highs and hold those gains? If we do, that breakout level usually is a really good place to put a stop, either a physical stop or a mental stop. Make sure we remain above that breakout level. But overall, this is a stock that has been holding up fairly well. And I think if the market is going to strengthen for year end, charts like this would most likely at some point start to resolve to the upside. It has not quite done it yet. And I think that's why it's an important chart to watch. When you think about some of the growthy areas of the market that have rotated lower, I was looking at a chart, or looking at on my dashboard earlier on stock charts, just the FANG stocks, the FanMag stocks, which are those six names that we tend to talk about. And earlier in the day, it was sort of mixed. You had about three of them higher, three of them lower. By the end of the day, all six of them in the red to varying degrees. And Facebook was sort of in the middle of that group of six stocks. Facebook illustrates the rotation that you've seen in a lot of the growth stocks that had been leading through early September. This is the market going to new high. This is the S&P and the NASDAQ confirming new all-time highs, as you've seen strength in areas like Facebook. And then this is the market in correction mode. Stocks like Facebook, particularly on the short-term time frame, have rotated from uptrend to downtrend. So when people ask me, well, hold on, what sort, is it really a downtrend? Look at a weekly chart, and you're absolutely right. I'm portraying one particular time frame. When we look at a 2-year daily chart, I'm certainly focusing on some of the short-term dynamics. But what I would argue is that it's all about thinking about some of those key levels. For Facebook, I think it's one of those charts we have a pretty good sense of what would hold this chart in bullish mode in the long term. I think there's a scenario where a chart like Facebook hits resistance at 380, which it did July, August, September, pulls back about 38.2% of the way, retraces the March 2020 to September 2021 rally, pulls back about 38.2% of the way, which would pull us back to around 290 to 300, which would be another 20, 25 points plus or so, depending on where we're at. We're at 325, 25, 30 points ish. We get back down to those levels. Then we rotate higher and show strength into year end. And that would sort of satisfy the long-term bull case and be a pullback within the context of a long-term uptrend. I think that's sort of the general way that I'm thinking of charts like Facebook. The real disaster scenario for stocks, charts like Facebook continue to pull back, break down through their 200-day moving average. Instead of finding support around 290 to 300, which would be previous price lows, which would also be the breakout level from last summer, which would also be the first Fibonacci support level, breaking 290 all of a sudden makes these charts look a little bit different. This shows you a stock, or that would show you a stock that is not holding support, but breaking support. I think the longer term charts, the weekly charts, are going to start to show the depth of that pullback, and have to remind you that this may not be a short-term price and time deterioration, maybe a longer slog that you have to navigate. And you really need to think about some of the downside potential on charts that you're looking at. I think that's a key level to pay attention to on something like Facebook. So with Home Depot, it's all about, is it able to push on to new highs? Is it able to eclipse previous resistance on a chart like Facebook that's in pullback mode? Is it able to hold the levels that would still make this a long-term bullish trend? And this is still a tactical pullback within a longer term uptrend. I think if you start breaking a level like 290 on Facebook, you have to decide, is this really a short term pullback or something deeper, more sinister, more long term, that you really need to review the upside potential on a name like this versus the downside potential and the risk of holding it through any further potential price deterioration. That was a long way to go on Facebook, but it's a fun chart to talk about. The chart of Home Depot reminds me a little bit of the chart of some of the financial stocks. KeyCorp in particular is one to keep in mind. Just like Home Depot is in that basing pattern, the financial stocks have done very well. We looked at the XLF and how it's testing new all-time highs, and I think KeyCorp is a really good example of what some of the financial sector looks like. Again, bond markets closed today, so through the remainder of the week, we'll see how bonds open up tomorrow and what some of the interest rates do, what some of the ETFs that we've been following, how they evolve. But the chart at KeyCorp, I would argue, is at a key juncture as well, similar to Home Depot, right? Made all-time highs into May, testing resistance around 23. And the question now going through the remainder of this week, does this end up being a double top pattern? Have we got resistance in May and now we're retesting it before we break down and retest those previous lows, retest the moving averages that we bounced off of over the summer? Or are we able to eclipse these and push to new highs? I think the bull case for stocks would involve stock charts like KeyCorp actually resolving to the upside and breaking above those May highs, which is why I think it's a key one to watch. We don't have a much more time to talk about individual names, but I would encourage you to set up your dashboard so you're able to focus on some of the highly rated names, charts like Asana that have started to work after not, things like Energy, which have emerged and showed position of strength. Also, the market movers. I often look at the market movers on the S&P to see some of the charts that are rotating to periods of strength and weakness. It's worth noting, even as the market's distributing through the course of the trading day today, in the materials sector, you have Mosaic making new all-time highs, making new closing highs, up 3+% on a day when the S&P is down. So there are charts making new price and relative highs. Those objects, those little widgets on your dashboard can be great ways to just make sure you don't miss any of these stocks that are on the move. And also make sure you check the ones that are not working. Particularly, we've beaten on things like luxury retail, apparel stores, things like Gap and others that are really showing some short-term strength. So make sure you spend some time reviewing those charts if you can. We need to wrap the show, though, and go to the three charts in 3 minutes. Here we go. Chart number one is a little look at breadth. We didn't have a chance to talk about this during a market recap, but it was interesting. I had this chart up during the course of the day. Earlier in the day, most of the stocks were up, or at least over half of them were higher. And during the course of the day, this red bar started to get higher and higher. The green histogram started to get lower and lower. And this is the New York Stock Exchange advancers versus the total listings. And this is the decliners versus total listings. So it's interesting to note the distribution that you've seen. So about 58% of NYSE listings were down today. And that was a number that increased through the course of the trading day. And again, when I think of the markets in more distribution mode, in terms of breadth, this indicator being above 50%, showing you more than half of stocks are distributing. That would something that would confirm what I see as a distributive pattern in the markets. This is a chart I'm going to be watching. Also, the one using volume, which we've talked about on the show before. All right, so number two is the chart of Bitcoin. So we talked recently, last time I hosted this show on Wednesday of last week, the same chart was one of the ones that we used. And the chart of Bitcoin, I would argue, I always describe charts in terms of their path of least resistance. When I'm looking at the chart of Bitcoin, I'm seeing a chart where the path of least resistance appears higher. You see a stock or a chart that is rotated from short-term distribution phase to an accumulation phase. Think about the chart of the S&P in your head. This is why I talk about the importance of making new swing highs and new swing lows. Bitcoin getting above 50,000, eclipsing the August high, which it failed to do in early September. I think that was key. Now that it continued above 50,000, that big round number, which has served as support and resistance, 50,000, 40,000, 30,000, arguably 60,000 next. I think that's key. So the breakout above 50,000, super bullish. Testing that on any pullback would be key as well. But overall, that is a chart certainly in a positive trend. Finally, it's interesting to feature a market that was closed today, but I find myself doing that because I think interest rates are a key story. When you look at the chart of KeyCorp, when you look at the XLF, the financial sector, when you're looking at some of those areas of potential strength, that sector doing well really is relying on this chart continuing to go higher. This is the spread between the 10-year yield to the 2-year yield. You can do that, by the way, on StockCharts, just two tickers with the hyphen, the minus sign between the two. You can see the spread was narrowing May, June, July, and steepening or the spread increasing July, August, September, now into October. That line continuing to go higher tells you the story of improving financials. That's more of a tailwind to financial stocks versus a headwind, and overall tells you that this is a sector to think about with potential strength between now and year end. Folks, that is our show for today. Thank you so much for joining us every weekday after the close for the final bar. As a reminder, go to StockChartsTV.com to watch all of our previous episodes on demand. For StockCharts.com in Redmond, Washington, Dave Keller. Be safe. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.